So today, what we're going to be looking at is the Chapter 21 homework. And in Chapter 21, what we're really going to be looking at here is what we call flexible budgets and standard costs. And so as we look at this, what we'll see as one of the main themes coming up repeatedly is this idea of variance analysis. So before we get too far into this, I just want to take a second and kind of explain what we're going to be trying to do with variance analysis and see if we can understand why a manager might want this information. And so what we're going to see in this chapter is the purpose of our variance analysis is so that a manager can look at the beginning of the period and make an estimate as to what something should cost or how much revenue we should be able to generate. And then at the end of the period, we can come back and actually see how we did relative to that budget. Now, if you go back to the previous chapter here, chapter 20, what you'll notice is that in chapter 20, we only prepared a budget for a single quantity of output. So, for example, we would prepare a budget assuming we were going to make 10,000 units. And this works wonderfully for analysis after the fact if we do indeed produce 10,000 units. But what if we actually produce 12,000 units? Well, now all of my variable costs are going to increase. So if I'm just looking at basic cost, what I'll see is that I actually have unfavorable variances everywhere because all of my costs are higher than we expected. For this reason, it does not make sense to evaluate management based on a single type of budget. So instead what we do is we generate what are called flexible budgets. And flexible budgets allow us to adjust the budget depending on production levels. So for example, if we had 10,000 units that we thought we would produce, we would simply divide all of those variable costs out, get a per unit amount, and then multiply that by 12,000 to show how much that should be given the increased level of production. So we'll do all that as we get through this video. But I just wanted to take a second before we got too tired and too bogged down and just kind of overview exactly what we're going to be seeing throughout the rest of this chapter. Now, of course, this homework is through McGraw Hill, so we're going to jump right in to question number 1 in chapter 21. So this question tells us here that JPAC manufactures and sells mountain bikes. It operates 8 hours a day, 5 days a week. Using this information, identify costs as fixed or variable with respect to the number of bikes made. So what do we remember about our fixed and our variable costs? Well, so far, and what we'll see here again, is that we've always said a variable cost changes with activity level. So if I produce one mountain bike, I'll need enough metal to produce one mountain bike, or plastic, or whatever we're making these bikes out of. However, if I'm producing 100 mountain bikes, I'll need 100 times more direct materials. Does that make sense to you? Hopefully so. And so what we'll see here is as we're going through this, we'll be able to look at each type of cost and identify, is that going to change directly with the amount of bikes produced? Or is that something like a salary that's going to be the same regardless? And so we'll go down through these examples here. So the number of bike frames that we need, that is definitely going to be changing with the amount of bikes that we produce. If I want to produce one bike, I'll need one bike frame. But if I want to produce 10 bikes, I'll need 10 bike frames. So we can definitely understand how that one is variable. Screws for general assembly, that will also be variable. If I'm producing one bike or 100 bikes, I'm going to need a different number of screws. Direct labor, once again, also going to be variable because what we're seeing here is it takes us more time to produce more bikes, so we need more man hours, so we see that direct labor increasing. Now, taxes on the property, right? Property taxes, these are going to be fixed because the city, the state, whoever is assessing these property taxes, they do not care if you are in operation, if you're only producing one bike per month or 1,000,000 bikes per month. They're going to assess the same amount of property tax. So that property tax does not change in relation to production levels. Now, the next one that we see here, bike tires, once again, that will be a variable cost because as we produce more bikes, we'll need more tires to put on those bikes. Gas used for heating, well, that will also be variable. As we produce more bikes, we will need more gas to provide heating. These last three here, office supplies, depreciation, and management salaries, these are all fixed. And I think two of these inherently just make some sense to us, and those are the last two, depreciation on tools and management salaries. Now, I could hear an argument for depreciation being variable if we were, for example, using the units of production method of depreciation. That would be a fair argument. However, since it does not tell us, we assume a straight line method of depreciation, so directly our depreciation is not being influenced by the amount of bikes that we are producing. The one that I could see being a little bit confusing here is the office supplies. And so the office supplies, what you would need to think about here is, while that could vary, and it definitely could each month or each period, we're not asking if this varies in total. Instead, we're specifically asking, will this change with respect to the number of bikes made? And because I simply produce more bikes does not mean I need more staples. So because of that relationship not really existing between those two, we see that this office supplies will actually be identified as fixed in this case and not variable. So do be careful with that one, but hopefully the rest of these were pretty straightforward. And now that we've knocked out number one, we'll move on to question number two. So in question number two, what we're looking at here is how we prepare a flexible budget. So I'm just going to scroll down to the next page, and we're going to see a lot of the same information, but they've gone ahead and prepared a very nice table for us, and we'll just use this table as we talk down through this. So if you want, you may want to take a picture, really emphasizing this area here, so that you have that to look at as we go down to the next page. Because the next page, I do believe, cuts this off. So you might want to make sure you do have a picture of that somewhere just for reference, because when we move down to this next slide, there's not a way to copy and paste this without it not fitting well anyway. So I've not done that in this case where I normally do. So do know that ahead of time. So in this case, what we are asked to do is to compute four different things. We want to compute the total variable cost. We want to compute the total fixed cost, the income from operations with a sales volume of 14,000 units, and income from operations with a sales volume of 18,000 units. So we've got quite a bit we're looking at here. So the first thing we've got to do is figure out our variable cost per unit. So if you have that sheet that we just talked about, that top piece of this question as a picture, I'd suggest we look at that now. And you'll notice that what we have here are basically all the same accounts, but they're in a little bit different order. And that's because this is prepared in a contribution margin income statement so that we can very clearly see which costs are variable, which costs are fixed. So as you go down through this portion right here, what you'll be needing to do is determine, is each one of these costs a fixed cost? Is it a variable cost? How is it interacting with the quantity being produced? Now, I'm not going to walk through each one of those simply to save time in this video because they've already prepared this for us down here. Now, I do suggest you make sure you understand the logic for why each one is treated the way it is, but just for the sake of this video already being incredibly long, I want to try to keep this as concise as possible. But if you do have questions about why something is classified as variable or fixed, always feel free to reach out to me, and I'll be happy to explain those in greater detail if you should need that. So now moving down into this bottom table that we see, what they've done is they first identified all of our variable costs. And all of these numbers here are just coming from our table that we had right up top. The only thing that we have done is we've just gotten these down to a per unit basis. So what we're seeing here is the direct materials cost per unit. All right, so make sure you do realize this is per unit, and that explains why These are slightly different, right, than the numbers above that are in hundreds of thousands. These are just in, individual dollars, $20, $40 at a time, because we're looking on a per unit basis instead of on the overall basis. So that explains that discrepancy there. So what we'll see then is once we've added up all of our amounts and we've come down and we've added my $24 plus my 42, 26, 8, and 15, we will get total variable cost of $115 per unit. Now, of course, contribution margin is calculated the same way it has been all semester, and that is just by taking my sales price right here of 203 less my variable cost of 115, and that gives me my contribution margin of 88. So don't get confused with all the lines. That's all that's going on here. It's just a little subtraction right there. Now, to get to these numbers over to the right, all we're going to do is I'm going to take the values that I have here and I will multiply those based on the number of units that were expected to be produced in each scenario. So to get to this 336 from 24, I will simply multiply by 14,000, and that will take me to my 336. I'll then do the same thing all the way down, and then I will do this by 18,000, and that will give me all of these values as well. So hopefully that makes sense how we're getting through this table, and we're moving down through it fairly quickly. Now the next piece down here is dealing with our fixed costs. You will notice these costs are not listed as a per unit cost because they are fixed. They are not directly impacted by the quantity produced, so we just report those as the full dollar amount. So what we'll see here then is for my total fixed cost, we have our plant manager salary, advertising, admin salaries, depreciation on office equipment, which once again we're assuming is a straight line method of depreciation, which is how we get to justify that as fixed. We then have insurance and office rent. Once you take the sum of all of those, you'll see that your fixed costs remain the same as $1,080,000 regardless of if we are producing at 14,000 units or if we are producing at 18,000 units. So with all of that work done, now it's just a matter of filling in the individual pieces to the questions that are asked. So in question number 1, they've asked us for the variable cost per unit. That's $115, which we calculated right here. We then went ahead, and even though they don't directly ask us for it, we went ahead and calculated a contribution margin of $88 per unit as well. Now, as we move down to requirement number 2, you'll see that the total fixed cost is simply $1,080,000, which we saw on the prior slide. So I'll just slide back up so you can see that real quick. And you see that is the same in all 3 cases. So it actually does not matter because that cost is fixed. Now for the next part here, they ask me to compute the income from operations for the sale of 14,000 units. So what we've got to do is figure out our revenue that we'll actually generate. So for 14,000 units, I will take $203 per unit, which we see right here. I will multiply that by my 14,000 units because that is how many units we are looking at here. Then I will need to subtract my $1,080,000, which is my fixed cost. But I also need to subtract my number of units times my variable cost per unit. So in this case, this piece of parentheses right here that I'm about to do in red, just to show you, this is dealing with my variable component. So that variable cost, right, that's in this red area has to be dealt with differently than the fixed cost because I cannot just take $115 and pull it into this calculation because if I do so, I'm dramatically understating my cost because then I'm not recording all of those variable costs that hit on every single unit. So we want to make sure we don't forget that multiplication because it'll really skew your calculations. So now once you go through and you do this math, so you take 14,000 times 203, and then you back out 1,080,000 and you back out 14,000 times 115, what you will end up with is income from operations of $152,000. And we see that right here. So that's how we do this. I know there's a lot of information in this question, so please don't get overwhelmed by that. And just know if you go through this methodically, hopefully you can handle a question like this without too much problem. Now there is one piece left here. And so the last piece asks us to do what we just did, but to do it again. But this time we're looking at 18,000 units. So the calculations here are exactly the same as what we just did. There's only two small differences, and I'll highlight those with these red arrows. So the only differences are where the units apply. Notice the selling price per unit, that does not change. My 203 is still the same. Notice my fixed cost did not change. And notice my variable cost per unit, that did not change either. So really the only thing that has changed is the amount of units that we're doing these calculations for. So please do understand that. Don't get too bogged down in this and don't get too concerned where you feel like you've got this whole extra calculation to do. It's really not too bad, because once you've done this for the first requirement, or the third requirement rather, then you just do basically the exact same thing, switch out a few numbers for the fourth requirement, and you have finished problem number 2. So now that we have the first two questions done, we're going to move on to question number 3. So in question number 3, what we're looking at here is how we actually prepare a flexible budgeting performance report. So I'm just going to start by reading the question. So we see here that Bay City Company's fixed budget performance report for July is shown below. The $594,000 budgeted total expenses includes $450,000 in variable expenses and $144,000 in fixed expenses. Actual expenses include $134,000 of fixed expenses. So this will all be very important as we come down and actually fill in these tables. Now, real quick, I just want to discuss what you see in this table that I've just bracketed off in this blue bracket. And what you see here is they're just showing you what we had assumed versus what actually happened. And you'll notice another thing here. They're looking at units, and the units are not the same. So what we see is the fixed budget was for 8,100 units, but our actual results are only for 7,000 units. So hopefully what we'll see down below is that my sales result in an unfavorable variance because we have sold far less, so it wouldn't make sense for that to be the other way around. And we would want to see a favorable variance for our expenses because we didn't produce as many units, so our cost should be lower. That's just what our gut should tell us leading into this, although if there was something crazy happening in the market, you could still see something unexpected. But in this case, that's exactly what we see below, and that's identified here with these U's and F's. So anytime you see a U in this chapter, that's telling me that the variance is unfavorable. And anytime you see an F, that is telling me that we have a favorable variance. And so, as it sounds like, you do want, if possible, to see more favorable variances than unfavorable. Because what we want to see is, for a favorable variance, that means either we had more in sales, or more in sales revenue, and less in cost, or we had, and then for unfavorable variances, we would see a decreased amount of sales and revenue and an increased cost. So it's easy to see why we would prefer more favorable variances. So as we walk through this, we'll just kind of see how they came up with each one of these numbers. However, I do want to take a second and point out why we need to do this flexible budget. Right now, if I was just trying to see how this manager performed, and I used this fixed budget of 8,100 units, I would say you had an unfavorable variance in total, so I'm not pleased with you. Even though it may not be that manager's fault because our customers only demanded 7,000 units this period instead of the 8,100 we predicted. So there may be something outside of the manager's control that's actually affecting that. So instead, we perform what is called we create what is called a flexible budget, which is going to let us compare apples to apples and see if we had used our budgeting on a 7,000 unit basis and then we sold 7,000 units, how would you look then? Would we still see these unfavorable variances? Or do we notice now that this manager actually did a really good job? So that's what we're trying to answer, and that's what we'll see here. So for my sales, for my flexible budget, what I'm going to have to first do is figure out, well, what price am I selling my goods at? So they've given us that information, but they hid it a little bit. So instead of just coming out and telling us, oh, that selling price is however many dollars per unit, what they've done is they've given me my total sales dollars of $648,000 in my budget, and they divide that by 8,100 units. Because in the beginning, we thought we would sell 8,100 units and generate $648,000. So when we do this division, what we see is $80 per unit is my selling price. So I'm abbreviating selling price with the letters SP. So now I'll bring that $80 and I will multiply that by the number of units that we actually sold. So this will be $80 per unit times 7,000 units. And that will give me a total of $560,000 that we should have expected in sales revenue. You'll notice then that we actually generated $623,000 in sales revenue when we only expected $560,000 if we had known we were only going to sell 7,000 units. So based on this, you can tell this is a very favorable variance because we generated an extra $63,000. And of course, you get that by taking your $623,000 that we actually earned, back out the budgeted amount of $560,000, and that will show you a $63,000 variance. And in this case, it is favorable. So a $63,000 favorable variance. Now, please do be aware, simply calculating the amount correct, right, a $63,000 variance, will not be sufficient on the exam or in the homework. You then got to interpret that and tell me, is that a favorable variance or is that an unfavorable variance? And so that's what we've seen done here. Now for the next piece, I'm just going to clear out this over here so that we have plenty of room to work out the next one here for the variable expenses. What I'm going to do then is see what I had in my original budget. So in my original budget, what I saw was that my variable expenses were $450,000. And you said, well, where did you get that? I said, well, remember when we first started this and we just read the given information? It told us here that $594,000 in budgeted total expenses include $450,000 variable expenses. So don't forget about that, right? It took us a little bit to get through that first calculation, but don't forget about the facts that exist in the question. So we've got our $450,000, and we said at that point in time, we believed that would apply to 8,100 units. So when I do this division, I'll come out to $55.56 per unit. I'll then multiply that by my 7,000 units that were actually produced. And when I do so, I will get variable costs under my flexible budget of $388,889. Now, what we then need to figure out is how much of our expenses were actually variable. So, you say, well, how on earth do we get that? They only told me actual expenses included $134,000 of fixed expenses. What they did not tell me, though, was how much of that was variable. So what you're going to have to do is look down in this table and see what your actual what your actual total expenses, were. So you'll take that $564,000 of total expenses. You will then reduce that by the $134,000 that is your fixed expenses. Whoops. Accidentally clicked that arrow. So that is our fixed expense piece. And that will bring us to the actual variable expense portion of $430,000. Now, just real quick, if we just look at this, we expected to spend $388,889 in variable expenses. We actually spent $430,000. Without even doing the math, can you see that this is going to be an unfavorable variance? And that's because our actual cost exceeded that budgeted cost. Now, to get down to our contribution margin, we once again just go straight down the list. So we take sales minus variable cost or variable expenses, and that will give me my contribution margin, in this case, for actual of $193,000. Now, the question was pretty nice. They actually did give us the total fixed expenses for both pieces. So we see right here, now it's just a matter of plugging those in the correct locations. So once we've dropped in the correct budgeted and actual amounts, we now can see my income from operations actually is $59,000. But when I prepared this budget on the correct number of units, I see I was only actually expected to generate income from operations of just over $27,000. So, would you have wanted to be upset with your manager because they didn't do as well as you thought, simply because you came in and evaluated them on the wrong measurement? Right? It's not fair to look at this as compared to 8,100 units when they only actually were able to sell 7,000 units. So we want to make sure we see that, and we want to make sure we're making these evaluations in a nice, fair manner. And so that brings us to the end of question number 3. So moving on to question number 4. Here we are just calculating standard unit cost, and then we're going to calculate what is called total cost variance. So the first part of this, requirement number 1, is really not too bad, because they tell me here that we are computing the standard cost per unit. So when you are computing the standard cost per unit, you will use the standard information. So real quick, I do want to point one thing out while I'm thinking about it before we move on. Notice that this information applies to questions 4 through 6. So as we move through the rest of these, I do believe I have the relevant information, which is primarily this, copied down onto those pages. But if you're following along at home, just make sure that you realize that 4, 5, and 6 all actually go together. So you'll be using the same information for each one. So to calculate my standard cost for direct materials, I will simply take my 6 pounds that we see in my table right here. I will multiply that by $8 per pound, and that will give me $48, which you see right there. Now, you'll just go down and do the same thing for your direct labor. This will be 2 hours times $16 per hour, or $32. And finally, for your overhead, we'll take 2 hours times $11 per hour, or $22. We then take the sum of all of this, so 48 plus 32 is 80, plus 22 gives you $102. And that's exactly what you see right there. So that gives me my standard cost per unit. So that's the first part of question number 4. Now moving on to the second piece of question number 4, and I've gone ahead and jotted out these calculations just to save us some time. But what you're going to see here is we're just needing to compare your actual and your standard costs. So the actual piece here is going to be coming from the fact that we had an actual usage of 46,600 pounds. So you see that right there. Then you see the actual cost that we ended up paying was $8.20 per pound. And so we see that the total actual cost for direct materials is $382,120, right? We just multiply the 46,600 by the 8.2. Now for direct labor, we then see that the actual amount of direct labor is this 15,100 hours times $16.50 per hour. So we see both of those right here. And we're then able to come in and see that when we multiply 15,100 by 16.5, we will get a total amount for direct labor of $249,150. The next piece here is going to deal with my overhead, and we see here that the actual overhead is just given to us of $174,800. Now when we sum up all three of these amounts, all right, so I'll switch to red just so you can see it a little bit easier. So we sum straight down through here, and that will give me $806,070 in actual costs that we have incurred. Now the question that we have to ask is $806,000 a good amount? Is that the appropriate amount for us to have incurred in the production of these units? And the only way to answer that question is to look back and see what we actually ended up doing. So in this case, we produce 7,700 units, which they give us right here. So now for my standard, I will use the number of units that were actually produced. Yes, that's 7,700, and that will drop into each of these calculations. We will then multiply that by the quantity of usage, so 6 pounds, times the price per unit. So in this case, $8 per pound, and that tells me that my standard amount for direct materials comes out to $369,600. I'm then able to do the same thing for direct labor. So I'll take my 7,700 units. I will multiply that by my 2 hours per unit, and I will multiply that by $16 per hour. You'll then see that that multiplication brings you to a total of $246,400, and we'll do the same thing here for the overhead, and we'll see that when we do that, we generate $169,400. Now, when we come in and see the total, we see that the total that we should have spent was $785,400. But the total that we actually spent was $806,070. So if we spent more than we should have spent based on our budget, does that sound like this is going to be favorable or unfavorable to you? Well, hopefully you see that that is an unfavorable variance, and that's exactly what we see right there. So the way we got this $20,670, once again, we just take my $806,000 minus my $785,000. And when I do that, I will generate this $20,670 as the amount for my unfavorable variance. Now, if you want to see any of those calculations in a little bit cleaner format, those are all right here. So feel free to pause the video here, look this over if you want to, but this is all the stuff that we just talked about. So I'm going to go ahead and move on, but I did go ahead and include that just in case you wanted to see it there. Now for number 5, what we're going to look at here is computing our first actual variance. So here, what we're going to say is is not necessarily enough to know that a variance exists. Instead, I'm going to want to know exactly why that variance exists. And it looks like it deleted, so let me go back up here and grab the information that we need one more time. Just going to clear this out so we get a nice clean copy. So we'll just grab this right here. We'll copy that down and we will drop it right here for us so that we have that information readily available to us. So what we see here is the first step in seeing how these variances break down is to actually break this into two different pieces. And so the way that the book teaches this, and this is fine, is what I've always referred to as the pitchfork method. And you see why, because basically what we are doing, thought I had switched back to the pen here, is you're breaking this into three pieces. And if you think about it, it looks kind of like a pitchfork. So that's what I've always referred to this as, and I think it's a pretty common reference to this. And so what we'll see is how this is going to help us determine why these variances exist. Because simply knowing that a variance is there, that is useful information. But if I don't know what is causing that variance, I don't know how to fix it and how to prevent that variance from occurring every period or with every run of production. So we want to make sure we're able to drill into this information and get the most useful stuff out of here for us. So in this case, the first thing we're going to do is break this into an actual section, which we have right here, and a standard section. So you'll notice here, for the actual, we deal in actual quantity and actual price. And for the standard, we deal in standard quantity and standard price. So what we're going to need to be able to do is come in and figure out how much of this variance is generated because we paid too much for my materials, and how much of this variance is coming about because we simply used too much in my materials. Because it is possible I could have a highly unfavorable price variance, but have an even more favorable quantity variance. And you say, well, how would that happen? And the answer here is simple. I paid more for my products, for the materials to put into my products, but because I got a higher quality material, I could use less of it. So you could see something like that. In this case, however, what we're going to end up seeing is that we actually just have two unfavorable variances, which is also possible. So we paid more for that, and we were very wasteful, perhaps, in our production processes. So we want to make sure we can identify where these variances are occurring so that we're able to root those out and improve performance. So in this case, the first thing that we said was to take actual quantity times actual price, and it looks like it deleted the piece on me here again, so give me just a second to get that back. So here's where we're going to start. I see that my actual quantity, in this case we are looking for the direct materials price variance. So my actual quantity is 46,600 and my actual price is $8.20. And so we just drop those straight in here. Now the next piece that we need to look at deals with the standard cost, so the standard quantity and the standard price. So my standard quantity here was 46,200, and you say, well, that's great, but they didn't tell me that anywhere. So how on earth did you calculate that 46,200? So if you remember, we said we produced 7,700 units, and we expected each unit to use 6 pounds. If you multiply that out, you will come out to your 46,200 pounds. And that's exactly what we see right there. Now the standard price per unit is just given, so there is our $8. So now what you want to try to figure out is how did these variances occur. So now that we've got the basic setup and we've got our two extremes, now we can start mixing the two. So this middle piece that we're going to deal with is going to deal with actual quantity times standard price. And so if you look, what we're actually setting up is a way for us to just be able to subtract a couple of times, and we'll be able to figure out how these variances came to be. So here in the middle, we take our actual quantity, which is this 46,600 pounds, from right here. So that 46,600 drops in, times my standard price, which we said was the $8. So now when I multiply that out, I get this $372,800, which says for the quantity we produced, if we had bought this at the price we expected, we would have spent this much. So that sounds great. So what we're then able to do is basically we can just come in and do some subtraction, and we get our first actual answer here. So if I just take my 382,120, I back out 372,800, what I will see is that creates a difference of $9,320. Now, we're not going to talk favorable or unfavorable just yet. We'll leave that for down to the bottom. But for right now, we do have our first actual answer. Now we'll do the same thing going across the other side. So now we'll take my 372,800, reduce that by my 369,600, and I get my second answer of $3,200. So what we'll then see is that my direct materials price variance, which is this right here, is $9,320, and it is unfavorable. And the reason for that is if I had paid the same price that I had expected, I would have only paid $372,800. But instead I paid $382,120. Now, that tells me this must be unfavorable. For the other side of this, what we are looking at is how quantity impacted the variances. So here we're looking, and if you really slow down and look at this stuff, what you'll notice is you could actually just rewrite these as separate formulas, because the only difference between your actual cost and this middle piece, you could essentially rewrite as actual quantity times actual price minus standard price. And then over here on the other side, what you would want to see is that for that direct material quantity usage, you could essentially rewrite this as standard price times actual quantity minus standard quantity. And so if you prefer to do this with formulas, that's how you would do it. But you can also use this type of pitchfork method that we've seen here. So either way, whatever makes more sense to you is totally fine, but they will both give you the same answer. Now, what we're then going to have to do, based on the way we have this set up, is we just subtract these two. Now what we see is the standard cost that we had budgeted was only $369,600, and instead we came up to $372,800. This tells me that I spent more, and as you see here, the only thing changing is the quantity. So I'm able to isolate that change and pinpoint it on the fact that we just used more materials. And so we're able to very easily see that right there. Now, the next piece that we want to look at down here is number 6. But actually, before we move on, I just want to point out one thing. All they're doing in this very last piece, they're just taking the sum of both of your unfavorable variances and getting a total direct materials variance of $12,520. Notice because these are both unfavorable, they simply add together. If you had one favorable, one unfavorable, they would need to be netted across. And so now with that, we can move on officially to number 6. So number 6, what we're doing, once again, we're still using that information from question 4, but now we are looking at calculating our direct labor variances. So in this case, what we see is that what we need to do, once again, is first break this into actual and standard components, and then in the middle, we'll do our mixing of the two to help us see how this all works out. Now for actual, we see actual hours, which is 15,100, and that's right there, and our actual rate of 16.5. And for our standard, we will see 15,400, which is calculated, of course, as my 7,700 units, which we see here, times my 2 hours per unit, which we see right there. So then we get 15,400 hours, and my standard rate, once again, is just given as $16 per hour. So once we multiply out on both sides, we get 249,150 and 246,400 respectively. Now, would it be possible for us to have, say, an unfavorable rate variance, but a favorable efficiency variance? And the answer, of course, is yes, and that's actually what we're going to see when we get down with the calculations in this question. You say, well, how does that make sense? What situation is this actually describing? And so what this is telling you is, yes, we paid our employees a higher rate than we expected. But maybe because we were willing to pay a higher rate, we were also able to get better employees. Or maybe our employees are more well motivated and they worked a little bit harder and a little bit faster. And so you can see that somehow by bumping the pay a little bit, we were able to improve efficiency by enough that we were actually able to recoup, if not all, at least some of that. And the question is, was it worth it? All right, that's really what we're looking at here is, okay, are we okay with paying them more because they're producing better? Or is the pay bump not helping us get enough of a gain in efficiency to justify that pay increase? And so that's the real question that we are trying to answer in this case. So here now in the middle, once again, we're taking our actual hours times my standard rate. So what we're going to do then is, once I have pulled in those relevant numbers, right, my 15,100, that is my actual, and my $16 is my standard rate, I now have my middle value that I'll use to compute both of these side values. So the first thing I'll do is take my actual cost minus this merged amount of 241,600, and that tells me I have a variance of $7,550 related to the rate. And real quick, if we think about this, we can hopefully identify that this is going to be unfavorable because we are saying, yes, we paid you $250,000. But based on what we expected to pay you, we only believed we would end up paying $242,000. Now, the next piece here is to come in and take my 241,600 away from my 246,400. And when I do that, I realize that my standard cost is actually greater than what we incurred of 241, which tells me that I actually did well in this area and I've actually got a favorable variance. So in this case, I do see unfavorable direct labor rate variance of 75.50, just right there, and a favorable efficiency variance, but only of 4,800. Now the question is it worth it for me to continue paying this increased rate if I'm only gaining $4,800 in efficiency, but I'm giving up almost $7,600 as this rate variance? And the answer is, of course, no. So what we're seeing here then is that my total direct labor variance is $2,750, and it is unfavorable because my rate variance outweighs that efficiency variance increase. So we do have to be careful. We do have to understand both sides and see what is actually happening in this case. And so that wraps up question number 6. We're finally done with that set of information, and we'll get some new information here in number 7. So in number 7, we're doing essentially the same thing we just did. We're just going to do it again, just with some extra information, or some different information rather. So in this case, we're looking at direct materials and direct labor variances. So in this case, what we see then is it tells us Reed Corporation has set the following standard direct materials and direct labor costs per unit for the product that it manufactures. So we then see here, during June, the company incurred the following actual costs to produce 8,100 units. Now, the actual quantity that we see here for my direct materials is 124,500, so that just drops straight in, and the actual price is 3.80. Now, to produce 8,100 units, we then need to figure out how much material we would need, and to do that, what we're going to have to do is realize that we're actually told up here in the very top how much direct materials per unit we need. So that is going to be 8,100 units times 15 pounds per unit, and that will give me a total of 121,500 pounds. Now, the standard price, of course, is just given. We then have our merged value here in the middle, where we take our actual quantity times our standard price. Now, the same as we did in the prior question, we'll simply take actual cost 473 from my 498, and we see we only spent $473,000 on materials, but given the quantity we needed, we should have spent $498 if we had paid what we thought we were going to at the beginning. So you do see how this is a favorable variance because the company is paying less for the materials that it needs. Now, for the other part of this, we need to figure out how we did on quantity usage. So in this case, what we'll then do is once again take my 498 and my 486, subtract those two, and we'll see that we actually used $12,000 more worth of materials than we should have. And so what we see then is the only difference between these two pieces, I'll just do this in green. The only difference between these two pieces is that quantity difference, because the price, notice in both, is just the $4. So the price is not changing, but the quantity is changing. And so we want to make sure we understand that right there. And that brings us to the end of that question, at least of this requirement for that question. We then take the two together, the 24.9 and the 12, and we see, in this case, we end with a favorable variance. So now moving on to the second part of question number 7, we'll do this the exact same way that we just did for the materials, but here we're doing direct labor. So in this case, we'll take my actual hours of 29,200 and my actual pay rate of 15.2 on the left side. For my standard, I will find my standard rate of $15 per hour. And then I will remember I am producing 8,100 units, and I need 3 hours per unit, which is told to me right here. So there's my estimated 3 hours per unit. When you do that, you will see that gives you standard hours of 24,300 hours. And I got carried away and put in a dollar sign there, but that is really just in hours. So 24,300 hours at $15. So this tells me my actual cost was $443,840, and my standard cost was $364,500. Now, what we need to do is break this into its components. So I'll take my $443,840 $440, I will subtract my $438, and I will see that that gives me a variance of $5,840 that is unfavorable. So what this tells me is that I did pay my employees slightly more than I had expected, which we could of course tell before we even began, because we can see the actual cost was $15.20 per hour, and we had only budgeted $15 per hour. So we're able to see that our math actually makes sense. And notice that we could have done this kind of analysis on the other variances we have calculated up to this point as well. So if you want to go back and do that on your own, do feel free to do so. Now the next piece here then deals with the actual efficiency variance. So in this case, we should have only incurred $365,000 for the amount that we produced, but instead we incurred $438,000. So that difference there tells us that we used far more time per unit. And if you actually do the math on this and you take 29,200, divide that by 81, you see it's taking almost an extra hour per unit, well over an extra half hour at least per unit. So we do have some efficiency issues that we'll need to get sorted out if we want this to turn around. So this does generate a massive unfavorable variance of $73,500. We then sum up my two unfavorable variances, and that gives me a total direct labor variance that is unfavorable of almost $80,000. So we do want to definitely look into this and try to turn this around. Now, question number 7 continues. Not the actual question, but most of the calculations that we just talked through. Here it is in a little bit cleaner format. If this makes more sense to you, feel free to look at that as well. Now, number 8, we're going to compute and interpret labor variances some more. So this time we're doing it for 2 months. So they tell us here the Javante Company set standards of 2 hours of direct labor per unit of product and $16.10 per hour for the labor rate. During October, the company uses 13,000 hours of direct labor at a $212,000 total cost to produce 6,700 units of product. In November, the company uses 17,000 hours of direct labor at a $278,000 cost to produce 7,100 units of product. So what we'll need to do then is figure out how to calculate the variances that we need for this question. So in requirement number 1, we need to look and see exactly what is going on. So in requirement number 1, it tells us here to compute the direct labor rate variance, the direct labor efficiency variance, and the total direct labor cost variance for each month. Classify each variance as favorable or unfavorable. And I just want to hint at what we're going to end up doing, which is point number 2, which tells us that they investigate variances of more than 5% of actual direct labor cost. Which direct labor variances will the company investigate further? That will be part 2. But I do want to kind of pull your eye to that, just so you don't lose track of that as we work through this question. So this question, they didn't give us a nice table like we've had in previous questions. We have to dig a little bit to get all the information that we need, but hopefully we'll still be able to figure this out. So in this case, we see that in October we have 6,700 units, and in November we have 7,100 units. I just want to go ahead and jot that down just so we don't get those numbers twisted as we move through the question, because there's quite a bit going on in this one. So we want to make sure we have this all nice and organized before we really dig into it. So in this case, we want to calculate initially, once again, our actual side and our standard side. So for the actual side, what we're going to do is we're going to take that actual number of hours that was used, which they told us was 13,000 hours in October. So we just drop that right there. And we see the actual rate that was paid of $16.30. And they told us here that we paid our employees $211,900. And so the way that we got this 16.3 is to take that, I've got the highlighter, just one second. We take our $211,390 that we actually paid. We will divide that by my 13,000 hours that was actually worked, and that will give me this 16.30 for my actual pay rate. So before we even do anything else, can you tell me if we're going to have a favorable or an unfavorable rate variance? Well, I think you can, and the reason I think you can is you can see now we are paying $16.30 per hour, but we only estimated, or we only budgeted to pay $16.10 per hour. So right away you can tell this is going to be an unfavorable variance. Right now we're just not quite sure the amount, but we know it's going to be unfavorable. Now the next piece here tells us we need to deal with our standard cost. So our standard cost told us that we wanted to produce 6,700 units, which would have taken 2 hours per unit. So therefore we would have seen 13,400 units. So when we look at this, I'm sorry, not units, 13,400 hours would have been needed to produce these 6,700 units. Now, if we look back at the facts, we see we indeed produced 6,700 units, but we only used 13,000 hours. So if we used 400 less hours, that is going to be a favorable efficiency variance. So in this case, what we're going to do then is just take the difference between my 211,900 and my 209,300. When I do so, that gives me a $2,600 unfavorable rate variance, which makes sense because we knew initially this would be unfavorable since we paid our employees more than we had budgeted for. The next piece then deals with getting this 6,440. To do so, we just take my 215,000 that we expected to spend because of the amount of hours, back out the 209,300, and that generates this $6,440 favorable efficiency variance. Now we just take the sum of these two, or really the netting of these two since they're in opposite directions, and what you'll then end up with is a $3,840 favorable total direct labor variance. Now in this case, neither one of those will need to be investigated further because 5% of our actual is almost $11,000. Neither one of those variances exceeds that amount, so we do not need to investigate any of those items any further. So we'll move on to November, and in November we'll do the exact same thing. So in November it tells us the company used 17,000 hours of direct labor, so 17,000 hours at a total of 277,950. So if I take my 277,950 and I divide that by my 17,000 hours, what I will see is that my actual rate is $16.35. And once again, the way that we got that was we just took that $277,950. We then divided that by my 17,000 hours, which generates this $16.35. Now, we had an unfavorable rate variance before, and it looks like that will continue into this period because we are still paying more than the $16.10 that we had budgeted. So that handles my actual cost side once we've done that multiplication between my 17 and my 16. Now we need to deal with my standard cost. So the standard cost to produce 7,100 units. For my standard hours, I will multiply by 2 because we are still using the standard of 2 hours of direct labor per unit of product, which tells me that I have 14,200 as my standard hours. We'll then multiply that by my standard rate of $16.10, which generates this total here of $228,620. We now use our handy subtraction setup that we have, and we just take $277,950, back out the $273,700, and we see that $4,250 of unfavorable variance occurred because we paid our employees more than we were supposed to. Now on the other side of this, what we'll then see is when I take my $273,700, I reduce that by $228,620, I have a $45,000 unfavorable efficiency variance, which means we're using a lot more time than we should be. And since that is far more than the 5% in this case, we will need to investigate that further when we actually look into requirement number 2. So in requirement number 2, it says which direct labor variances will the company investigate further? And we said this was the direct labor efficiency variance, specifically relating to the month of November. They don't ask you that, but that's the one that's really got the big problem. Now that brings us to the end of number 8. I'm just going to kind of scroll down through these fairly slowly just so you can get a good snapshot, or you can get a good pause screen in here if you want to look at these. But this is really just an explanation of everything that we just did on number 8. So hopefully it makes sense, but if it doesn't, feel free to look through this. It's a little bit cleaner than what we just did. And it continues on through here. Okay. And let me get that still for you so you've got a good spot to pause, and we'll move on to number 9. So on number 9, what we're going to look at is how we are going to compute total variable and fixed overhead variances. So in this case, what we are going to do is I'm going to come in and see that the Sedona company has set the following standards that are right here, and I'm going to see a bunch of extra information as well. Now, for this question, where we are going to have to begin is to figure out the standard costs that actually need to be used here. So in this case, what I'm going to do is to figure out my variable overhead cost. I will use this based on my level of 70% of the factory's capacity. So I'm going to find my 70% operating level column, and that's where I'm going to be pulling these numbers out of. So for variable overhead, what I'm going to do is, and I'm just going to draw these with arrows to kind of give you an idea of what I'm doing, but there's no way I can fit all 3 of these calculations in that small area. So I'll take my $1,706,600 in budgeted variable overhead. I will divide that by 742,000 budgeted hours. So I'm just dividing those 2 units, or those 2 numbers rather, and that will give me $2.30 per direct labor hour. Now for my fixed overhead cost, what I'll then do is I will take my $890,400, which we see right here. I will divide that by my $742,000, and that will generate a rate of $1.20 per direct labor hour. And finally, to get my total overhead, you could add these 2 together. So 230 plus 120 gives you 350, or you could take the 2,597,000, divide that once again by your 742,000 direct labor hours to get a total of $3.50 per direct labor hour. And so if you were on the exam, I'm not going to know how on earth you got this, and I'm not going to know on the homework either. What I will tell you, though, is I strongly suggest you recalculate this and then add these 2 together anyway. Doing so will give you the best opportunity to get all of these pieces right, because if you had a mistake somewhere else in your calculation, it gives you that chance to catch that error and to go back and make sure you've done your math properly. Now, for the next piece here, what they want us to do is to compute the total variable and total fixed overhead variances, and then we'll classify each as favorable, unfavorable, etc. But I've gone ahead and boxed in, even before I started this assignment with y'all, that this is only at the 65% of operating capacity level. And you say, well, why is that? And it's because if you look back up at the given information, they tell us during the current month, the company operated at 65% of capacity. Employees worked X number of hours, and the following actual overhead costs were incurred. So now what we'll need to do is pull these predetermined overhead rates that we calculated right here, and we'll just drop those in right there. So the first part, already done. Now the next part here that we need to look at is this 689,000 direct labor hours, and we'll just pull that straight out of our table right there. So they told us at the 65% operating level, we expect 689,000 direct labor hours. So just put those right there. Now you just multiply this 2.3 by your 689,000. And when you do that, you will get 1,584,700. So you just multiply straight across, and that gives you this next cell. The next thing that we've got to look at then is, what were my actual results? Well, if you scroll back up, you can pull your actual results from this section right here that they told us. The actual overhead that was incurred was $1,525,000 in variable overhead and $954,000 in fixed. So you just pull those numbers straight through to there, and you can just calculate your variance then by taking $1,584,700 minus $1,525,000 and $826,800 minus $954,000. So now the question is, we've got the numeric value for these variances, but we do not know if they're favorable or unfavorable yet. So now we have to interpret this. If I applied $1,585,000 in overhead, but I only ended up using $1,525,000, then that will be a favorable variance, because we were able to do this with less variable overhead than we expected. Now the fixed overhead, we only applied $827,000, but we actually used almost $1 million, so right at $954,000. So when we do that subtraction, what we see, unfortunately, is a $127,200 unfavorable variance. So now we just net those two together, and when we do so, we see that we end with a $67,500 unfavorable overhead variance. So that brings us to the end of question number 9. And once again, here are some of the calculations that we just covered in a little bit clearer format, perhaps a little bit at least nicer writing. So now with that said, we can move on to number 10. So in number 10, what we're going to look at is how we are going to compute total overhead rate and total overhead variance. So in this case, it tells us here that World Company expects to operate at 70% of its productive capacity of 23,000 units per month. So we've got 70% of 23,000. It then tells us at this planned level, the company expects to use 12,075 standard hours of direct labor, and overhead is allocated to products using a predetermined standard rate of 0.75 per direct labor hour per 0.75 direct labor hours per unit. At the 70% capacity level, the total budgeted cost includes $48,300 in fixed overhead and $144,900 in variable overhead. In the current month, the company incurred $197,750 of actual overhead and $11,625 actual labor hours, while producing 13,900 units. So in this case, what they're going to have us do is start by computing these predetermined overhead rates. So to calculate these predetermined overhead rates, the first thing I'm going to do is take my budgeted cost for my variable overhead. So if I just look up here, they told me that my budgeted cost for variable overhead was $144,900. So $144,900. And I will then divide that by my 12,075 direct labor hours. So we do that division right there. And when I do that, I will come out to $12 per direct labor hour for my variable overhead cost. And then I'll do the same thing for my fixed overhead cost. So I'll take my 48,300 divided by my 12,075, and that will give me $4 per direct labor hour. Now, what we need to do then is complete this bottom section of our table. And to do the bottom section of my table, what I'm going to have to do is figure out my predetermined overhead rates, which we just did. So I'll just drop these straight down. I will multiply that by my standard direct labor hours. And for that, I will take my 13,900 units that we produced, and I will multiply that by 0.75 direct labor hours per unit to give me 10,425 standard direct labor hours. We then multiply across, and that gives us our applied overhead for each. Now in the end, we see we have applied $167,000 in overhead, but we actually incurred $198,000 in overhead, giving us an unfavorable variance of $30,950. So that brings us to the end of question number 10. So with that said, we can now move on to question number 11. And in question number 11, we are computing volume and controllable overhead variances. So in this case, it tells me that World Company expects to operate at 80% of its productive capacity of 56,250 units per month. And at this planned level, the company expects to use 28,000 standard hours of direct labor, and overhead is allocated to products using a predetermined standard overhead rate of 0.62 direct labor hours per unit. At the 80% capacity level, the total budgeted costs include $64,170 for fixed overhead and $315,270 for variable overhead. In the current month, the company incurred $340,000 of actual overhead, $24,900 in actual labor hours, and produced 38,000 units. So, the first thing that we need to do here then is to figure out our fixed overhead per direct labor hour. And so to do that, what we're going to do, take my 64,170 that we see here for my budgeted cost for fixed overhead, and that's just found right there. I will then divide that by 27,900, and that will tell me that I have $2.30 per direct labor hour. And of course, this is in hours on the bottom. Specifically your direct labor hours, and those are just given right there. And that generates this $2.30 you see right here. Now the $23,560 hours that you see right here, the way you're going to calculate that is by taking your application rate of 0.62 times your total of 38,000 units, and that gives you 23,560 hours. And so we see the 0.62 right here. They told us we apply this using a predetermined standard rate of 0.62 direct labor hours per unit, and we see that we produced 38,000 units. And so now we have calculated both of those first two numbers. Now to get this 54,188, it's just a matter of multiplying those two numbers together. So we just multiply straight down, and that gives me my 54,188 in fixed overhead that was applied. Now the budgeted fixed overhead is 64,170, which we said we see right here in this third line of the paragraph. So we drop this right here, and the difference between those two, since the amount we applied is less than the amount that was budgeted, that will be unfavorable because we're expecting to spend more. So this is an unfavorable variance from requirement 1. And now we'll move down into requirement number 2. And in requirement number 2, it's just a matter of plugging in a bunch of stuff that we've already done for the most part. So we see that our total actual overhead of $340,000 just comes straight from the last line of that paragraph. We see this $266,228, which we've not actually dealt with yet, but the way that we're going to get that is by taking my $11.30 per variable hour per direct labor hour in variable overhead, and we'll just multiply that by my 23,560 hours, and that generates this 266,228. Now the next thing that we've got to look at here is this fixed number, and the fixed number that we saw a moment ago is straight out of the given information, and of course because it's fixed, it's not changing. So now we take the sum of these two numbers, which gives me my 330,000, and the very last step in this homework assignment is that we actually just take the difference between those two numbers. And so what we see here is that we actually incurred $340,000 in overhead, and our flexible budget told us we should have only incurred $330,398, which tells us we spent more than we should have by $9,602, which generates an unfavorable variance. So that gives us the end of question number 11 and the end of the Chapter 21 homework. So if you have any questions, do feel free to reach out to me. I'll be happy to try to answer any of those that you may have. But otherwise, I hope this helped, and we'll see you next time. Thank you.